In this week's update, the great US global rotation reset continues. So many explosive commodity moves makes a real statement. And where to for gold and silver? My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Now, this is big picture stuff that I'm going to present here. So this will play out, or is playing out. We're probably still at the very start of it, but will play out over many, many years, perhaps decades. And this is really around the Sell America trade, which certainly advanced during 2025 and looks as though it's starting off in 2026 in pretty much the same way. And fundamentally, it makes sense because the US has become a less orderly place, a less orderly market for a number of reasons, and is starting to lose its luster. Now, how that impacts individual investors depends very much on what sectors you're in and what you own. But in markets, confidence is absolutely critical. When confidence gets lost, then all sorts of nasty things happen because capital moves. And what was a very predictable and stable market and was the first stop for global capital now has an element of sovereign risk when you look what's happened in recent months, or even in the last year or so since the current administration started. And it means that it is causing a shift in money flows because money will not stay in an environment where it feels that things are just too uncertain. It'll find another place. And so it is causing a shift in money flows across currencies, across equities, and across commodities as well. And we've seen that very dramatically in the number of commodity moves and also in the general trending down of the US dollar. And there's umpteen reasons backing that. I'm not going to go into them now because I'm sure you've read about them in many places, but there are multiple factors here that are just shaking the confidence of global capital in the American market as being stable and reliable. And that's why it remains so vital, and I talk about this every single week, it remains so absolutely vital that your main trade management signal should be technical. It should be reading the money flows, reading the charts, and acting accordingly, because anything else is just way too slow. You can't read a fundamental argument and then expect to time your exposure in the market according to that fundamental argument. It's just, you're going to be way, way too late. You're going to be months too late. And markets are so volatile these days that a lot of things can happen. So it's so critically important that the money flows guide your actions in terms of entries and exits and management of weightings. Now, this doesn't mean abandoning US stocks, and I'll be far from abandoning US stocks. In fact, I've got a very active watch list of US stocks that are trending upwards in a very strong fashion, and I'm not moving away from that at all because there are still hundreds and hundreds of US stocks that have got powerful trends. But I'm very comfortable staying with that because I've got a very tight and very robust exit regime. If money starts flowing out of the transactions that I'm in, then I will go with that. So the message here is you've just got to be more selective about the sectors and the stocks that you pick, and more careful, more conservative in the way that you manage them. And this is why since halfway through 2025, we've seen a global reset of the really high multiple tech stocks and in some other areas as well. So basically high multiple stocks that were formerly market darlings. And locally in Australia, we've seen that with stocks like Car Group and Xero and 360 and Catapult, all these stocks that had done so well but were trading on high PEs. And those PE multiples are still being compressed. And they're being compressed to a greater degree than I thought was likely. And the reason is that we've just got this shift of capital to other areas. So this really underpins the other really important thing that I hammer every single week, and that is your exit plan needs to be, and I was searching around for the appropriate word, and I think pristine is a good word for it. Your exit plan needs to be really pristine. And the good thing about that is if you're armed with a really pristine exit plan, then you can have even more confidence in what you're doing because you don't have to worry about the trends that you're in. You ride them until they stop. Now, you don't get out at the top, but with a good exit plan, you can get out not too far off the top. And it just becomes an unemotional, repeatable process, as I'll talk about later on. So where is the shift going? Well, it's going into commodities, for one. And despite the fact that we've seen some amazing moves across a number of different commodities, the signals are that this is still very much in the early stages and that we've got years, if not decades, ahead of us for these commodities. Now, this is not a straight line. Let's be very clear here. This will be very volatile and it will be exciting and it will be, at times, if you put yourself in a position, it can be depressing. And that's why the plan and the exit strategy is so important. But make no mistake, the tailwinds are going to be behind commodities for a long time to come. Whether you look at the fundamentals, so the fundamentals around supply and demand, surplus or deficit, or whether you look at the technical signals, which is obviously my preference, it's very bullish. Both of them are pointing to very, very bullish trends that will continue for some time or have the likelihood of continuing for some time. Now, in the short term, the US dollar has strengthened a bit in the last week or so, and that presents some very short-term headwinds, but doesn't change the big picture one little bit. It just means that there's a little bit of overhead pressure, if you like. Now, developers in the mineral space are likely to offer a far better reward for risk than the producers. And the reason for that is that money flows initially when a sector starts to gain favour and starts to attract global capital, then the money flows into the larger cap producers first. And they go up initially. And they go up and they get somewhat overvalued because they get more of the future priced in. But then the money starts to filter down the food chain and gets down into the advanced developers and then down into the explorers. Now, that's where the real leverage is. That's where you can make much greater percentage returns. But it's also where the largest risk exists as well, and it's extremely volatile. But there's every reason to feel very confident about a multi-year advance across many, many commodity sectors, and even including soft commodities as well. They're still looking as though they're starting to make some serious gains. Now, I just thought I'd retouch on something that I did last week because I think it's really important. So I'll just quickly run through this again. And that is the fact that I've always been driven primarily by what the money flows are saying, combination of use fundamentals to make sure you get in the right fishing hole and then use technicals to engineer your entries and your exits. And that's not changed at all. All I've done is I've shifted the balance a little further to the right, if you like, emphasizing more the importance of momentum. So respecting the money flows, really important. This is difficult for a lot of people to grasp because we expect that logical conclusions should lead to logical outcomes, but in the market, they don't. So don't allow logical conclusions to dominate your decisions because I think you'll be on the wrong side of being right 50-50. I've also increased my weightings to early stage stocks for the reasons that I just talked about. We've seen the producers move. The time for the early stage stocks or the advanced development stocks is certainly in full swing now. And it's the best environment that I've seen for a long, long time for stocks that can increase in value by 5 or 10 or 20-fold over coming years. That doesn't provide any sort of guarantee, but it's just the environment is so fulfilling for stocks to do that. And that can include resources, across many different resource types. It can include digital healthcare, and it can include various forms of technology. So the bottom line is, if you follow the 7 megatrends that I've been talking about for several years that have got unstoppable tailwinds, then that makes sure that we're fishing in the right pond. That makes sure that we've got a tailwind behind what we're doing. Now, it doesn't mean that things just go straight up, because clearly they don't. But if you've got a strong tailwind and your timing's not quite right, then maybe you just need to wait a little bit longer and things will correct themselves. So the technicals are very much there for guiding the entries and the exits. What never changes? The value of a clear and simple plan that just takes the emotion out of it and allows you to execute consistently. You got to be honest about your tolerance to volatility. You've got to know your purpose for every stock you own, and different stocks can and will have a different purpose. You just got to be clear. You got to know why you own something. Just buying a tip or a recommendation or something out of a newsletter is just not going to cut it, not in this sort of environment. You need to know what your exits look like. We can never know where they are, but we can know very, very clearly what they look like, so that when they appear, we react to them. Next is shutting out the noise. Be aware of all the negative biases that we all carry around in our head, and that can creep in very easily if you allow it to. So catch yourself out with a negative bias, because fear sells. The media is about clicks and eyeballs, and their goals are definitely not aligned with ours. So that was from last week, and I think it was just valuable to recap on those couple of slides. Now, it's also really, really important to get all the advice that you need lined up before you start really active investing. Absolutely critical. Turning now to the American market, the S&P was down 0.4% for the week. The NASDAQ was down by a little bit more, but it was the small caps, the broader part of the market. And this is what's really impressive about the US market at the moment, is the breadth. The Russell 2000 was up another 2.1%, which is very impressive against the major indices. And IWM, which is the ETF covering the Russell 2000, beat the S&P for the 11th straight week. We also saw the RSP, which is the equal weighted S&P, that went up, where the S&P, which is obviously dominated by the mega cap stocks, actually went down. So again, this is very good for healthy. It's not so good if you're in the stocks that are being sold down, but it's certainly an indicator that the American market is broadening, and that's a positive thing. And we've seen the fact that smaller cap stocks have underperformed the rest of the market, whether it's America or Australia, for years and years now. And that is very much starting to change. But despite the fact that we've seen a lot of very, very powerful moves over the last 6 to 12 months, there is still a valuation gap that is unusually large. So by no means the fundamental gap has been closed. The US dollar index continued to rise, edge up a little bit, 99.38, which is interesting given the fact that everybody seems to be conceding that rate cuts are going to happen in 2026. The 10-year yield, pretty much unchanged, 4.18, and the VIX also still in the 14s and 15s. Let's go and look at some charts now. We'll start with the NASDAQ composite, and nothing really much has changed. This is a daily chart. If we go back to last Friday, that is that candle there. So there's last Friday. So there's the week that we've had. So it's really just tracked sideways and just dragged down a little bit on Friday. If we look at the S&P, pretty similar. This is a weekly chart. So if we go back and put this on the same basis, then they're looking very similar. The NASDAQ perhaps consolidating sideways a little more, but there's the RSP on a weekly chart, clearly up, and that's the Russell on a weekly chart. So we've had 2 very strong weeks. So breakout, retest, and now it's off again very strongly. Looking at some of the other important charts, this is a semiconductor ETF, SMH. On a daily chart, you can see it's still tending to trend very nicely. It's bouncing off this 50-day moving average, the blue line. And at the moment, it's sustaining itself above the 8-day moving average. That's how strong the trend in semiconductors is. If we look at where the relative money flows are going, we've seen energy bounce back very strongly over the last week or so. Materials right up the top, and then we're starting to find the more aggressive sectors, XLC, XLK, the more aggressive technology sectors of the market are now right at the bottom. And Australia looks pretty similar, and no surprises here. We've got materials really leading the way in a major way, with BHP and Rio doing really well. But we've also got small caps. So small cap miners are really in a sweet spot at the moment. And they're all outperforming the ASX 200 by quite a long distance. All right, turning now to the Australian market. Aussie dollar finished at 66.2 and it's stuck. It's becalmed, not doing anything. Doesn't need any more comment. The ASX 200 was up 2.1% for the week. We are seeing a bit of over-exuberance in some hot themes, and I'll talk more about this when I get to the commodities section. So this is where you really need a very tight, reproducible, unemotional exiting plan. The volatility here is just so high that unless you're really fluent in what you're doing with reducing your exposure or just taking it off the table altogether, you're going to be twisted in knots by this kind of market. It's absolutely essential. So resources, critical metals remain a priority, but just bear in mind that the volatility is going to rise to very significant levels from time to time. And so position sizing as well as an exit strategy is a key part of this. Some trends are really stretched. We've got day traders that are very active. You see it when you watch the intraday action. So your purpose and your time frame must be crystal clear. If you buy into a stock just because it's a tip or a recommendation from some source, you don't really know what they do. You don't really know why you're in it. You don't know how long you're in it for. Are you going to absorb short-term volatility because it's a great unfolding story? Or are you going to be a more active trader? You've got to know these things before you start. There's no point in scrambling around when prices start rolling over and falling 10, 15% in a single day. That's not the time to be making decisions, because then your decisions will be totally emotionally driven. So have a quick look at the Aussie market. Okay, there's the ASX 200 on a weekly chart. So quite a good week with the banks doing a bit of rebounding towards the end. So this is a weekly chart on the banks. Healthcare, still struggling, still in steep downtrend. The technology part of Australia, similarly, it's certainly not a very encouraging chart. That's the ASX 200 resources index. So a very powerful week there, and materials looks very, very similar. Let's just have a quick look at the currencies. This is the American currency. You can see on a weekly chart, we've had 2 weeks of bouncing, but we're still within this overall consolidation. So you've got to say that we're in downtrend. The shorter term moving averages, the 50-week and the 20-week moving averages have turned over and are heading down quite steeply. The price is generally below them all, and it won't be too long in the 200-week moving average will have rolled over and be heading in the downwards direction as well. So definitely downward bias to the American currency, which is all part of this global de-dollarization trade. And the Aussie dollar, not much change there. Turning now to precious metals, another really strong week. Gold was up $85 to almost 4,600, so it was up 1.9%. And if you translate that into Australian dollars, a whopping 68.78. Incredibly profitable territory. And that's why producers are still being undervalued. And I think we'll see that when we get into Australian earnings season. I think there'll be many surprises to the upside. Silver did even better, in fact, a lot better, up 12.7% and finished over $90. From a fundamental perspective, there's been a bit of a regulatory crackdown in Shanghai. The silver's futures trading market was getting a bit unruly. The high-frequency trading algorithms were being blamed, and so they were the target of a crackdown on regulations. So that has caused some of the volatility in silver. But the fact still remains that Chinese traders have been willing to pay a premium over the spot prices in London. Now that has led to a very, very rapid rise, a parabolic rise, as we'll see in a minute, and one that's unsustainable. So that will normalise, but of course we don't know from what level and when that will be. But just recognise that this is a market at the moment where the trend is not sustainable, either fundamentally or technically. If we look at gold stocks, the ASX, the GDX on the ASX was up 7% last week. But despite that, despite the big moves, the big gains that we've seen, most producers still remain undervalued. Certainly the better quality ones do. So I think this earnings season, when it gets started, will be a catalyst, another move up in the Australian gold sector. And of course, my favourite sandbox is developers that have got the most merit through the nature of or size of their resource, the quality of their management and track record, or their strategic attraction. And when you've got stocks of that nature, then the current valuation is not really the point. The stock could be trading at 10% of net present value, can be trading at 50% of net present value, and you'll find examples of both of those. But it doesn't really matter because that's not what the market is focused on when you've got stocks in development phase. If we look at silver, as you'll see on the chart in a minute, the metal's gone almost parabolic. Now, clearly that's unsustainable, but silver mining stocks have got massive upward momentum and finished off the week in America, despite the volatility in underlying silver, metal finished off the week with some very good gains. So I think we'll probably see a pretty good opening in the Australian market on Monday morning. So how to play silver ETFs, if that's what you've got, tracking the underlying metal or silver stocks, then the playbook really is about staying with the momentum until the market tells us to reduce exposure. We don't reduce exposure because we kind of feel that it's the right time. That may prove to be way too early. You just leave too much profit unattained. So be prepared to see the price peak and roll over. Just have an exit strategy that gets you out fairly soon after the rollover. And that is the most profitable sweet spot for trading silver stocks or any stocks that have got that sort of upward momentum. So it requires an unemotional, repeatable process, and you've got to be prepared to give some profit back. If you're never prepared to do that, then you'll never make a trader or an investor, at least not a successful one. So failure to operate, just to tie all these ends together, failure to operate a tight and coherent and repeatable plan means you're not going to make a fraction of the profit that's there for the taking. So let that thought linger for a few seconds. Let's go and look at some charts. And we'll start with the metals. First of all, we'll start with silver because this is the most spectacular. So this is silver on a weekly chart. So we broke out in the middle of October, had a couple of weeks down, and then just absolutely rocketed off from around 50. And now we closed the week at 90. And you'll see we've had several gaps, several big gaps from when the market closed on Friday to when it opened again on Monday. And that indicates an absolute scramble on the part of the buyers. Now, that's a parabolic trend that is not sustainable. I don't know when and where it will finish, but I certainly know what it looks like for me to respond to it. There's the gold price, also on a weekly chart in US dollars. Not quite as spectacular, but still very, very strong. And in Aussie dollars, we finished the week up at 68.74 as indicated. Now, if we go to the gold stocks, so this is the Aussie Index GDX, you can see an incredibly powerful week, in fact, really powerful 2 weeks. And backed by very good volume last week as well. And listed in the US, this is GDXJ, covers all but the really big mega gold producers. And that's also looking very, very strong. And importantly, the signs are that these trends are going to continue over the longer term, but they can't continue without periodic bursts of consolidation. That consolidation can look like this, 3 or 4 weeks to the downside, not very much downside, not much percentage retracement, or they can be something more substantial. So that's why setting targets for exits is such a flawed strategy, because we really have no idea how far and how fast these trends can move. All right, turning to other commodities now. Copper was flat, around 585. There was a little bit of late week softness. Copper came back. It was above $6 on Wednesday and Thursday, came back on Friday. But the trend remains strongly higher, and you want a bit of backtracking every now and again, because otherwise the market just gets too overheated and the correction then becomes much larger. So we've got exploding demand in copper. We've got stockpiling, which is adding to that exploding demand. And we've got tight supply, both for structural reasons, in other words, just the amount of copper capable of being produced, but we've also got some shorter and medium-term reasons caused by weather events, caused by strikes, caused by several different factors. So this really is the perfect storm for the copper space. So this is very much a market about buying the dip, quality producers, quality standout developers, and it's highly likely that this market is going to continue for many years to come, but volatile. And also beware as well that there is a rising tide in the copper market, and as always happens, whether it's technology or copper or whatever it is, the rising tide will also elevate some real garbage as well, stocks that don't deserve your investment dollar. So you've got to be careful that you're working with just the stocks that really are high quality. Crude oil, 59.3. Structurally, it's bearish. The long term, as I've been saying now for weeks, I avoid it in Australia because of our energy policy. It's such a mess that it creates uncertainty. So investors, to my way of thinking, just don't have the odds in their favour. So I would be avoiding the energy sector in Australia or the crude oil sector in Australia. But for traders, there could be a near-term opportunity setting up here, just from a purely technical point of view. Let's turn to some charts now. There's the spot copper chart. So we've just come off that peak above $6. Spot nickel also pulled back to a degree, but it's moved up very, very strongly. Still remains to be seen whether this is just a news-driven blip or this is a new phase for nickel. Spot aluminium also just took the opportunity to have a little bit of a pause. Lithium carbonate. Spot uranium also rising very strongly again. So the uranium sector has definitely been responding, whether it's in Australia or in America. And there's the crude oil chart as well. All right, so wrapping it up, it's highly likely that a multi-year, perhaps even multi-decade trend in commodities has started. And if you look at the demand sources for things like copper and lithium and rare earths, and other key critical metals, it's really difficult to see where the endpoint in rising demand is, because it's just so tied into the couple of really major megatrends around AI and also around decarbonisation, the energy transition. So if you get yourself organised, you can really reap the rewards in coming years. But if you're not organised, then all bets are off. Those who don't or can't because they don't have the knowledge or the time or the interest, which is absolutely fine because that's most people, then you're going to get pummeled in this market. The volatility is going to be so high that you'll start getting into a cycle of making mistakes. You'll chase prices, get in too high. You won't get out when the signals are there, and then you'll think about getting out when we're close to the bottom. It just gets completely messed up. I've been working with traders now for nearly 20 years, and I've seen it happen over and over again. So that's why every week I keep reinforcing the need for a plan. So what do you require? It's a simple but effective plan. It's got to be simple. Anything that's got any level of detail to it probably won't work because it's something that you need to visit every day. You need to be able to ingrain it in your psychology. So it needs to be an effective plan around what you buy, when you buy it, and how you buy it, which gets to the importance of waiting. You need to understand the cycles at all levels and what really drives prices. And in many occasions, and even more so these days, it's not what you read in your textbook. It's what you learn on the job, in the market, over many years. And the most valuable commodity that a trader and investor can have is confidence that comes from repeating things that are high probability. Most will work, some won't. But it's the repetition of a process that works that gives confidence. And that is the most valuable commodity that you can find. Portfolio Analyst last week, we did a cross-section of resource stock analysis and also looked at the really important concept of risk versus reward. So that's it for this week. I'm expecting another highly entertaining week next week. There's more information on our website. There's my email address. And I will be back with you next Sunday. Cheers.